The cut in the LPR last month, it didn't do much in terms of new bank lending because we saw growth in outstanding loans falling on a month-on-month basis. Basically, the growth was coming in less than expected. What do you make of that?
So actually for the lending, it was mainly driven by all the loan growth. It was mainly due to the demand rather than the rate. So on one hand is that among 30% of the total loan balance is individual loan. So for the individual loan, it is highly tied to the secondary market property price. So starting from 2021, and especially after 2022, the secondary market property price has been declining. And therefore, the overall personal loan growth has been slowed down. It's not only about the mortgage, but also everything, including the credit card and also the consumption loan, even SME owner loan. So combining them together, the personal loan growth seems has a closely relationship with the secondary market property price. So for the personal loan, it's very hard to boost the growth without a recovery in the property market. For the corporate loan, it was mainly due to the ties to the company's expectation about like future orders. In the past several months, while the overall macro figure seems to be fine, but new orders seems still in a downtrend. So for corporate, they don't have too much pressure, or they don't have too strong demand to increase the capex. That's the key issue. And also for the PBOC, actually they mentioned quite a lot about money supply versus the deflation in their first quarter monetary policy report. PBOC mentioned that while quite a lot of people think that the PBOC should increase the money supply, and given the current deflation in China, the PBOC think that every time when they provide more money supply in China, for example, urge banks to lend more to corporate, it will always result in more capacities and further enhance the supply rather than the demand, and then results in deflation. So actually, the loan growth seems not the top priority for the regulator at this moment. So overall, on one hand, is that loan growth is not tied to the rates, but more tied to the demand. And the second is that it's the loan growth seems not the top urgent for the top priority for the regulator at this moment.
So not a top priority, but what is the impact on credit growth with a deepening deflation picture?
So on one hand is that in the past several years, we see that although banks are trying very hard to lend loans, but the loans was, on one hand is that the loan growth largely collapsed due to the demand, and also due to there was a regulatory ban starting from last year, saying that banks are not allowed to lend loans to corporate with lower yield than the treasury yield. So you can see that before the ban, quite a lot of banks already lending loans below their cost. So on one hand is that banks already tried very hard, and the corporate doesn't have strong demand. And the second is that after the collapse of the loan growth, especially starting from last year, second quarter, we haven't seen further worsening or further decline of the deflation. It's still, the PPI and CPI seems to be relatively stable. So in the past 1 year, it seems that the loan growth, the impact from the loan growth to the deflation or to the overall price is quite limited. We think China should emphasize more on the demand side, like domestic demand, and also, China is also trying to continue to boost its export amid the trade war. But the loan growth or the financial sector money supply doesn't seem to be have a significant impact to the overall pricing in China.
Amid the economic uncertainty, how are mainland banks maintaining their growth? Can you give us an update on the health of the Chinese banking sector?
So on one hand is that China banks are still trying to grow the loan, although the loan growth slowed down quite a lot. And second is that net interest margin decline, although it will continue, but the decline is a bit moderate comparing to last year. So overall, we still see that China banks operating income like either slow down, either the growth slow down or decline a little bit year on year. But overall, the bank's profit may still largely remain flat year on year or like decline less than 5% in this year. So I think that's also close to the market consensus at this moment. On the other hand, for the asset quality, yes, banks' asset quality should tie to the change of the profit growth. But overall, we see that banks' reported NPL ratio seems to be still stable, while the retail sector's NPL ratio increased a little bit increased in the past 1 year. So overall, banks are still able to deliver a stable profit and also stable dividend at this moment. That's also why we still take banks as our top priority in our financial and property sector.